Hello and welcome to the weekly commodity market update. I'm Brownfield's Will Robinson, joined by the University of Missouri's Ben Brown. Good morning, Ben.
Hi, Will. How are you?
Doing pretty well. Had a nice weekend trip to St. Louis and back, so back in Ohio now. And Ben, you had a little excursion yourself that also took you through Ohio.
That's right. I went to Tennessee for a couple of days of spring break and came back through Ohio on my way back. So it was fun. It was a good time. I completely underestimated how many people go to the Great Smoky Mountains. I had no clue that it was the nation's #1 most visited park, and I can tell you that there was enough people there that I am convinced that it is the nation's most #1 visited park. So it
Well,
was fun. It was a good
I,
time.
I'd have to agree with that too, because I was there November of 21, I want to say, and it was yeah, it was a lot more full than I thought it would be. And I wonder too if the pandemic kind of boosted its traffic, it being such a outdoor and kind of
Yeah,
open spot to visit. So
beautiful. It's really pretty, really nice, but lots of people.
oh
Lots of
yeah, yeah. So Ben, as we look at the market adjustments over the last week, a lot of things to trade on. So where have we really ended up coming into this week?
Yeah, let's start on the futures market. So old crop corn for May up 9 cents to 6.57. New crop no December corn down 2 cents to 5.67. So some spreading in that market. Soybeans for May were up 70 cents to 15.22, back above $15 for the first time in about a month. November soybeans up 37 cents to 13.32. Soybean oil was up a little over 2 cents per pound. Soybean meal was up 11.80 per short ton. Old crop wheat was down 8 cents to 6.93. New crop wheat for July down 6 cents to 7.06. And then that West Texas Intermediate crude oil really jumped on Monday of this week, up $7.42 per barrel on the week. That was in relation to OPEC's announcements of production cuts.
So Ben, a lot of adjustments, some positive movement for corn and soybeans, and then those light losses on wheat. We had a lot going on last week. So really, what led us to where we landed at?
Sure, yeah, and there was a lot last week to pick from, and so we'll kind of go through this quick and see where our conversation takes us. I'll start on the energy side. U.S. stocks of crude oil, gasoline, and ethanol all fell on the most recent week of data, with gasoline use up 6% over a 2-week period. With all of these changes, ethanol production was up just slightly for the week. Ag export sales were all within expectations last week. Soybeans, grain sorghum, and wheat were all up week over week, while corn was down. But again, that's coming down from that extremely strong week the week prior due to those large Chinese purchases. Last week's first quarter hogs and pigs report showed fewer grain consuming hogs over the next 2 quarters compared to last year. That'll decrease feed use for the hog market, or in the hog market. March 1 grain and oilseed stocks reports came in below trade expectations and bullish for corn and soybeans, while above expectations and bearish for wheat. U.S. planting intentions report last week also showed farmers intended to plant larger corn and soybean acres than anticipated. Along with wheat in 2023 compared to 2022, everything was within expectations, but corn and wheat were bearish to the market, or the bearish end of the market, and soybeans were at the bullish end. It was announced over the weekend the Argentina government's going to start up their soy dollar preferential exchange rate for ag products starting Monday, April 3rd, and that's going to last 90 days. Ag export inspections were bullish for corn, neutral for soybeans, and bearish for combined U.S. wheat products. And then USDA's first progress report of crop conditions for the year showed that 2% of the nation's corn crop was planted. That matched our average. 4% of cotton acres were planted. That was down slightly from our 5-year average of 5%. And 17% of rice acres were planted, which was slightly up above normal. And then the progress report also showed that 28% of U.S. wheat was rated good to excellent, down from 30% last year. That was a lot.
So
But
yeah, there's been a lot to trade on, and the markets, I guess, kind of reflected that in their movement throughout the week, how they're kind of, constantly working. But really, I want to start the conversation looking at the acreage, the planting intentions for this coming year. We saw increases really across the board, and it kind of leads into the question, where do these acres come from? Because, thinking about how farmers operate, generally, you don't have just acres that you're like, we're not going to plant that this year. So how did we see an uptick across the board really for all three this year?
Well, so they were all three up compared to last year, but I'll remind folks that last year's total was down from what we would probably consider normal. Okay, so total principal crop acres came in just around 318 million acres. That's pretty much what I consider to be a full pie at this point. And certainly, even with higher input costs, the prices are suggesting that producers will continue to plant and plant as much as they can. So I was not surprised, I guess in my opinion, I guess, to see the principal crop pie come in right around 318 million acres. And then you start breaking that out across the different products. The big surprise was the I think the corn acreage number. Or at least that's what the market and kind of reporters really focused on. However, you could make a case that winter wheat acreage number was also equally as impressive, up almost 1.2 million acres, or a little over 1.2 million acres from what the trade had anticipated. And that was above, all estimates. It came up, even above the most bearish guess on the winter wheat side. So I think there was some notable surprises in the acreage numbers.
Well, not only some production news, obviously, with the estimates there's some expected, I guess, acreage that could lead into maybe higher production, depending on how the long growing season goes. But I want to turn to Argentina and the start of the new soy dollar preferential exchange rate. Ben, what's the impact really going to be within the market on this? How much will this really dictate soybean oil prices and all that implies?
Yeah, sure. So the Argentine government needs money. This is how they raise money. We saw them implement this twice last year. Both times it brought quite a bit of soybean products to the market. I think this type of intervention is now happening often enough that in my opinion, it's starting to influence Argentine farmer decision making, to where they're going to store that product, and even if the markets go up and incentivize them to sell markets into or sell soybeans into the market, there's still this loss aversion that's kind of out there of like, well, the government might implement a soy dollar program and I don't want to miss out on that. Even if the market's telling me I should sell now, they might implement it down the road. So I do think what we saw is, I think, farmers for the soybeans, and we know that crop was small, and corn, but they were holding on to everything they had because they were waiting for this preferential, kind of soy dollar exchange rate, right? That trades above, what the pesos trade to US dollars. So I'm maybe not surprised to see this happen, because I certainly think that until this cycle breaks, right, and we change the mentality, the behavior of Argentine producers, they're just not going to sell in unless the government announces a soy dollar program. So I think that's why it happened. It's likely going to bring soybean products to the market, which is going to help, I think, provide, kind of a bearish tint in the old crop market for soybeans as we look ahead, because Brazil certainly got a big crop. However, I'm still like on the bandwagon, I guess is what I would say, that when we get around to July and August, soybeans are going to be hard to come by in the global market, and places like Europe and other large importers are going to be looking to the United States and paying high prices for our soybeans. So I look for us to see July and August to be a decently strong soybean export window for us again this year.
Well, and with the timing of that program through Argentina, with it lasting 3 months, 90 days, thinking about where the U.S. is going to be, excuse me, sorry, the U.S. is going to be within our own growing cycle. It's still not far enough along in the year to where you can accurately predict, how much crop might be produced within the U.S. So how much do you think that's going to just inform the market at that point without knowing exactly where the U.S. is going to come out?
Yeah, sure. So this is the tricky part of behavior of markets in terms of how all this lines up. You're right. By the time we get around to the end of this 90-day period, there's a good chance we won't have all of our soybeans planted by then, right? Like, I mean, that's kind of the nature of this, in terms of, you're starting to look at a July, expiration for this. And as we've learned in some of our wet years, there's a lot of double crop soybeans and even some first crop soybeans that go in late June, early July. So not ideal, but certainly it's possible. And of course, the the true production potential of the soybean crop's not really known until September. And so we've got a long ways to go for that. The interesting thing, I'm going to switch gears here a little bit. We're going to stick with Argentina, but talk about this in the framework of Brazil, and even maybe in the framework of China and Brazil relations. My expectations for kind of some of our late season soybean exports, regardless of what our crop looks like, are really based on this notion that I have to believe that Brazil's going to produce a large corn crop, and their bins and storage space is going to be filled with this massive first crop soybean. So they're going to export that corn, and that's going to dominate that export window for them, May, June, early July, right? And so that's what's leaving Brazil is corn, not soybeans. And that's what allows the United States to maybe export soybeans at a high price later in the year, tightening maybe our supplies towards the end of the year. But I think for the time being, this Argentine program, this massive soybean crop out of Brazil, is really going to weigh on our old crop soybean prices here in the near term.
Well, yeah, talking about the near term there. So you're expecting some, near term bearish movement, maybe some pressure to push prices downward. But, like you said, long term, the picture remains tight when you look at, the potential global export market, especially the European countries trying to get product in as the U.S. enters more of a harvest mode there toward the end of the year. So, Ben, looking forward to the rest of this week. What should farmers, ranchers really be paying attention to when they're watching the prices?
Yeah, so a pretty normal week. Energy report on Wednesday, export sales on Thursday. Friday, we do get that ag trade data for the month of February at 2 p.m. Central Time. Then next Monday, export inspections and crop planting progress. So a pretty straight week.
All right, Ben. Well, it's always a pleasure having your brain on here to comb over. Looking ahead, viewers, listeners, if you'd like to learn more about what we do or find other episodes of ours, you can do so at brownfieldagnews.com. You can also find the weekly livestock market updates there as well. Well, Ben, thanks again. I'm Will Robinson on Brownfield.